Okay, so we've worked through all the classification issues. Now we are going to deal with the theory behind finance leases. I'm going to teach you a lot of theory through the journals, and sometimes with accounting it's sometimes useful to learn the what before the why. I'm going to teach you both simultaneously, but you better learn these journals. Okay, so just remember the classification. For a finance lease, we have substantially all the risks and rewards being transferred from the lessor to the lessee. So the lessor treats this as a sale, the lessee treats this as a purchase. Okay, so a quick overview of the accounting. Initial recognition for the lessee. You recognize the asset at the lower of the fair value of the asset and the present value of the minimum lease payments. That is very NB, right? And that, ladies and gentlemen, is for the asset, not the liability. Okay. Make sure when you're doing the minimum lease payments, the discount rate that you are using is the rate implicit in the lease or the incremental rate. You must go and learn the definition for what the incremental rate is. Okay. Initial direct costs, you'll see a lot of this within leases. Now, initial direct costs will be costs like legal costs, potentially your brokerage fee or your real estate agent fee, etc. if it's a property. The principle for when it's a finance lease, as a lessee, you will capitalize this to the leased asset and later on you'll depreciate it as part of the leased asset. Subsequent measurement, okay, here you're going to have your minimum lease payments, which are going to be made up of your finance costs and a principal or capital amount, right? That, in other words, is your installment. Okay, remember your amortization table. It's going to have an interest and a capital component for every payment for every period. Contingent rentals are expensed and that goes into profit or loss. And remember now your depreciation of the leased asset, right? Okay, and you must disclose this separately from the owned assets. So you're going to disclose separately from the owned assets. Now just remember that you must also include the initial direct costs that were capitalized in the cost of the asset when you are depreciating it. The disclosure we'll learn. I've got some nice formats for you. Okay, so the theory that we are going to learn through journals. Okay, the first thing is the initial recognition at the inception of the lease. We'll do that, debit asset, credit the liability. We'll have a bit of an issue around that. Then capitalize the initial direct cost to the leased asset. Then you'll have your installments paid. You'll split that between principal and interest. Then if the actual installments are not on the same date as a reporting period, well then you might have to accrue for interest if they are not what we call coterminous, i.e. installment date on the same date as reporting date. You will then depreciate the leased asset, and don't forget that you must classify the current portion of the lease liability, and that, ladies and gentlemen, is very much an IAS17 issue, financial instruments. Remember, this finance lease liability is technically a financial instrument, financial liability to be specific. So let's go, number one. Initial recognition at the inception of the lease. We will debit the leased asset, and remember that asset value will be the lower of the fair value of the asset or the present value of minimum lease payments. So minimum lease payments, you will work out all the payments. So payment 1, payment 2, payment 3 plus the future value. You will discount all of those, and you will get a value that will be value A. Remember, value A will probably include VAT. So what will you need to do? You will take VAT out. So you'll times it by 100 over 114, and that figure will be the value of the asset, if it is lower than the fair value of the asset. Okay, so yes, The asset is an IAS16 issue, but IAS16 is overridden by this IAS17 measurement issue. Okay, then we will obviously take 14%, assuming VAT is still 14%, account for that. And then the lease liability is including the VAT. Okay, so you will credit the lease liability with a full amount, and this is the amount that will be in your amortization table, not the value of the asset, right? And we're going to be smart. We're not going to draw up an amortization table. We are going to use a financial calculator to speed up that process. Okay, a couple of little other technical issues, not big things, but remember, investment property is not measured in terms of IAS17. Okay, that means the lower fair value or present value of minimum lease payments does not apply to IAS40, right? IAS40 overrides IAS17, which means you'll do initial recognition at cost. Okay, and just remember, guys, how are you going to work out your present value of the minimum lease payments? Well, amortization table is the long way to do it, and if you've got a spreadsheet, that's fine. But what can you take into an exam or keep with you if you're at practice? Your financial calculator. You must learn how to use that thing for this course. Number 2, we're going to capitalize the initial direct costs to the leased asset. So we are going to pay legal fees. Okay, those legal fees we will credit bank for the total amount, including VAT. The debit we will not take to expense. We will capitalize it to the leased asset in the statement of financial position. Just remember, this is the amount ex VAT, and the total payments will include VAT. Therefore, we'll have a little balancing debit. Okay. So from an IAS16 perspective, you treat this as a component of the asset, and you depreciate as a component of the asset. These costs will probably include legal costs, brokerage fees, etc. Now, just later on, there may be some deferred tax issues. Okay, that's a more advanced part of the studies, but you will need to see whether the initial direct costs, those legal fees, are a permanent difference or a temporary difference. If that bounces over your head for now, don't worry, we'll deal with it in future studies. Installments paid. So these are the contractual amounts that need to be paid annually, quarterly, monthly, whenever the lease terms are. So here you will have your financial calculator, right? This is all going to come from your financial calculator. The first thing is payment in your calculator. You will either be given the payment or you will need to calculate it. We'll deal with that as a financial calculator issue. Now that payment, when you go amort, periods 1 to 1, 2 to 2, 3 to 3, etc., will all need to be split between interest and principal. Okay, so the principal will reduce the lease liability, therefore debit the lease liability. The interest will be part of interest expense. We're going to call that finance costs in profit or loss. Whenever you're doing journals, tell me, is that line item a statement of financial position, profit or loss, OCI or equity? Be very clear on that. Okay, so you must know how to use the calculator's amort function. Okay, now I'm going to do an example or two on the HP 10B2. Very similar process on the Sharp, the Texas Instruments, etc. If you have any problems, more than welcome to email me. Then what happens if the installments, this one we've just looked at, is not on the same date as a reporting date? Well, then the cash flows aren't going to flow, but we still need to accrue for the interest at reporting date, right? So you'll take the interest, amort 2 to 2 interest or amort 3 to 3 interest, and you'll apportion it for 3 over 12, or if it's a quarterly period, maybe 1 over 3 months, etc. You will debit the finance costs and credit either the lease liability or have an interest accrual. For leases, I prefer the interest accrual account. Keep a little separate account. Because in the next year, what are you going to do? You're going to reverse the prior year's accrual. Okay, so if that's prior year, we would then go into current year and reverse it out. And then you would have a current year again, where this just becomes a cycle until the lease ends, right? Okay, so why would we reverse it out? Well, in the current year then, you would have the end of the year interest, the last year's interest reversed, as well as the full interest on the installment. Okay, so you want to get your profit or loss amount correct. Then, depreciating the leased asset. Remember, I've asked you to keep this separate from the owned assets, right? It's a disclosure requirement. You'll also have a separate PPE note, one for owned assets and one for leased assets. You'll have your debit depreciation expense like normal, credit accumulated depreciation, and impairment losses. Remember to please include the initial direct costs into the cost of the asset when you depreciate it. Okay, there's a very important thing that I need you to note. The depreciation period may not always be the economic life. If, for whatever reason, the lease term, if for whatever reason, legal ownership does not automatically pass to the lessee. Remember, it's not a requirement in the lease that legal ownership passes. So if it does not pass, then you will use the lease term and not the economic life, right? That is very, very important. Last, and this, so many people forget to do this, guys, but the financial lease liability, okay, is a financial instrument, and IFRS 7 says show how much is a current liability versus a non-current liability. So work out, use the amort function to see what is the principal for the next year that will come up and actually be paid back. The principal for the next year, the capital, well, that's going to be part of the current liability. So up till now, our lease liability has been a non-current item. We are then going to take it out, well, a portion out of non-current and put it into current. Purely a disclosure issue. Okay, learn the journals. Make sure you understand the basics and the little bits of information I've given you, such as this little tidbit of information for depreciation. Learn these before proceeding. Okay, thank you guys. Good luck.